If you bought a stock where you made 32 times your money in only 2 years, I'm going to take a wild guess that you would probably be pretty happy. And that is exactly what Charlie Munger did in the late 1970s with a company called Belridge Oil. Yet, in the 2001 Berkshire Hathaway annual meeting, when Warren Buffett and Charlie Munger were asked about their biggest investment mistakes, Charlie Munger actually brought up Belridge Oil, and the mistake wasn't, something that he got wrong about the investment thesis. It clearly worked out very well. The mistake was basically not betting big enough when he had a no-brainer investment opportunity presented to him. This is the second video in a three-part series on some of Charlie Munger's best investments, and in this video I want to present two different stocks that Munger invested in, one in the 1960s and one in the 1970s, one where Charlie Munger bet enormously for a relatively small gain, and one where Charlie Munger bet relatively modestly for a very large gain, and actually has some regrets around not betting bigger back when that opportunity was presented to him. So if you do enjoy the video, be sure to hit like and also subscribe to the channel so that you can see the other parts of this Charlie's Greatest Hits series. But without further ado, let's get straight into the video. Now I want to start this video by talking about Belridge Oil. This was the stock that Charlie Munger made more than 30 times his money in only 2 years in the late 1970s, and this is what Charlie had to say about Belridge Oil in 2001.
When I was somewhat younger, I was offered 300 shares of Belridge Oil. An idiot could have told there was no possibility of losing money and a large possibility of making money. I bought it.
Now, let's talk through what the situation was at Belridge Oil. Let's go through some of the numbers, and I'll talk you through exactly how much Charlie Munger actually invested, because we do have some of that information available. Now, on the kind of surface level metrics, Belridge Oil was just kind of an interesting, cheapish looking oil stock. It was a relatively small cap company, had a market cap of 110 million, had a book value of 177 million, so it was trading at a modest discount to book value. Now, looking a little deeper at Belridge Oil, there was actually some reasonably clear off financial statement value, and that was some land that Belridge owned in California, which had assets of about 380 million barrels of oil. Now, it sounds kind of crazy to throw around these oil prices given where the price of oil is today, but at the time the price of oil was about $5 or $6 a barrel, and if you took the 380 million barrels of oil and kind of compared that to the market cap of only 110 million, effectively Belridge was only being valued at about 29 cents per barrel of oil. So 29 cents versus $5 or $6 is clearly quite a large discrepancy in valuation, and it was a pretty kind of basic, straightforward kind of net asset value play here for Charlie Munger. That's about as complicated as the investment thesis got. And the story basically goes that Charlie Munger got a phone call in 1977, basically being offered 300 shares of Belridge Oil. This was a small cap, fairly illiquid company, so probably not super unusual to be offered shares in this way back in the 1970s, and he ended up buying those 300 shares at $115 each for a total investment of $34,500. So far so good. Charlie has found a very cheap oil stock, he's invested some money in it, but here is where the mistake comes up. So a few days later, Charlie Munger gets a second phone call and gets offered a further 1,500 shares of Belridge, and that would have required about $172,500. The 1,500 shares were offered to him at the same $115 share price, and he actually turned them down. And if I play a second clip from Charlie from the 2001 Berkshire meeting, this was what he had to say about turning down that offer.
The guy called me back 3 days later and offered me 1,500 more shares. But this time I had to sell something to buy the damn Belridge Oil. That mistake, if you traced it through, has cost me $200 million. And it was all because I had to go to a slight inconvenience and sell something. Berkshire does that kind of thing too. We never get over it.
So Charlie knew he had a great opportunity, he knew it was a no-brainer, he was offered stock at a great price, yet he turned it down because he had to go through the inconvenience of selling something else. Now, this is basically what happened over the next couple of years. So those phone calls happened in 1977, and in 1979, Belridge was actually bought out. There was a bit of a bidding war between a few different major oil companies. Involved in the bidding war was Mobil Corporation, Texaco, and Shell. And remembering that Charlie Munger paid $115 a share here, Belridge was eventually sold for $3,665 per share, or about $8 per barrel of oil. Now, of course, Munger's $34,500 investment did very well. It turned into just a slither under $1.1 million, and for Munger at the time, that was a very serious amount of money. So he got more than a 30-bagger in a couple of years, but of course he failed to put an additional $172,000 to work, which would have turned into an additional about $5.5 million. And just to make that opportunity cost pain even harsher for Charlie Munger, a lot of that profit from Belridge Oil was actually rolled into many of his big purchases of Berkshire Hathaway shares. That's how he got his kind of initial holding in Berkshire back in the day. And that extra money that he could have rolled into Berkshire had he taken up that second chunk of shares from the second phone call, would have allowed him to acquire about 21,114 extra Class A Berkshire Hathaway shares at the time. Back in the late 70s, they were trading for about $260 per share. Of course, fast forward to today, and they're over $400,000 per share. And that opportunity cost as of August 2022 is about $9.2 billion. And that right there is one of the biggest opportunity cost kind of mistakes I think I've ever seen. And it is the reason why when Charlie Munger thinks about Belridge Oil, even though he got a 30x plus return on the stock in 2 years, he does view it as a mistake, because his Munger family fortune could have been much, much larger than it is today had he purchased that second lot of 1,500 shares. Now, what's quite interesting to me is that Charlie Munger was no stranger to betting really big. It's not like he had, not gone heavy into a single stock before. It was actually probably a little out of character really for Munger not to jump on that opportunity. So I want to share a second story on a stock called British Columbia Power. Now this was actually in the 1960s, so about 10 or 15 years before the Belridge Oil situation. And in this example, Charlie Munger actually did bet very heavily. Now unfortunately for Munger, the return that he captured, although it was positive, was much smaller than the Belridge situation. The Belridge situation was like a 30x plus return, whereas British Columbia Power was basically, it went from $19 a share to about $22 per share, so a small kind of 15% spread, but he did it at enormous scale. This was basically like a merger arbitrage type situation where the stock was trading at 19 and they had an offer to be bought out at 22, kind of similar to something like the Activision Blizzard situation today, which Berkshire does actually have a position in as well.
At that point, Activision becomes a different kind of security. It becomes what Charlie and I used to call, everybody did, 50 years ago, we'd call them workouts or something like that. And we even went back one time, I think, on British Columbia Power, didn't we, Charlie?
Yeah, we certainly did.
Yeah. A guy named Bennett was up there, and we were trying to figure out whether some takeover of the power business. I mean, we spent a lot of time analyzing the probabilities of announced deals going through, and we call them workouts.
Now, this British Columbia Power buyout story is actually mentioned in this book, The Snowball by Alice Schroeder, which is one of the big, fat Warren Buffett biographies, and it's very good. I'm a little over halfway through it and steadily working my way towards the end. But here are a couple of sections from The Snowball about this situation. His impatience, this is Charlie it's talking about, his impatience stood out more than any theory that was emerging inside his head. He wanted to get really rich really fast. He and Roy Tolles made bets on whose portfolio would be up more than 100% in a year, and he was willing to borrow money to make money, whereas Buffett had never borrowed a significant sum in his life. "I need $3 million, Munger would say on one of his frequent visits to the Union Bank of California. Sign here," the bank would reply. With these huge sums, Munger did enormous trades like British Columbia Power, which was selling at around $19 and being taken over by the Canadian government at a little more than $22. Munger put not just his whole partnership, but all the money he had and all the money he could borrow into an arbitrage on this single stock. But only when there was almost no chance that this deal would fall apart. When the transaction went through, the deal paid off handsomely. So there you have a couple more of Charlie Munger's best investments ever. The first one being Belridge Oil, which was kind of weirdly one of Munger's best investments ever, but also one of his biggest mistakes, just purely because of the allocation that he put towards that stock. But still, in the 70s at the time for Munger, $1 million was still a very serious amount of money. And a second situation in British Columbia Power, where it was a much smaller spread, only a 15% kind of gain available, but Munger was able to capture more than a 15% gain on his partnership's equity, because he didn't just put the whole fund in there to get the full 15%, he also borrowed some money to kind of juice that return on equity. So some pretty serious kahunas to be able to do that with British Columbia Power. He clearly had a lot of conviction about that deal going through. If he had had that same conviction about Belridge Oil, he would be much higher up the rich list than he is today, but Charlie Munger, I'm sure, is still doing it right. So that is part 2 in this 3-part series on some of Charlie's greatest hits, some of his best investments ever. I do hope you enjoyed it. Be sure to hit like and also subscribe to the channel so that you can see part 3, and go back and check out part 1 if you haven't seen it yet as well. But that's it from me for this one, and I'll see you in the next video. Cheers.